If you'd like to earn CPE credit for listening to this episode, visit earmarkcpe.com. Download the app, take a short quiz, and get your CPE certificate. Continuing education has never been so easy. And now, on to the episode. Hello, everyone, and welcome back to Earmark. I'm Blake Oliver, joined for a second time by Noah Buxton, a prominent figure in cryptocurrency and digital assets accounting. He is the co-founder and CEO of the network firm LLP, bringing over 15 years of experience in tax, audit, legal, and regulatory compliance matters. Noah, welcome back to the show.
Thanks for having me back and for the very kind intro.
You very kindly indulged me talking about Bitcoin for an entire hour in our last interview together. And that was a lot of fun, but Bitcoin is just one type of digital asset. And today I'm eager to explore the whole space with you. And I understand that that is your specialty at the network firm.
That's right. Yeah, we're 100% focused on digital assets. I think we're the first firm to put ourselves out there in that way, 100% focused on this industry. Today, I think we're the largest, and I think there's a number of other firms, at least one in the US and a couple globally.
So digital assets started out with crypto, with Bitcoin. That was what everybody thought of when we thought of digital assets, but it's way bigger than that, right?
I think so. Yes. It's bigger than that in sort of the number of tokens you can count, for sure, right? You could look at CoinMarketCap or some of these other aggregator sites, and you can see, yes, Bitcoin is still the number one asset by market cap. There's hundreds or thousands, maybe even created every day. Definitely tens created every day, and so there's many thousands now, technically, of cryptos, right, running on many different blockchains. So,
but it goes beyond crypto. It's not just these digital currencies that we're talking about anymore when it comes to digital assets.
I think so. Yeah, exactly. By count, there's a lot, right? By opportunity of what this technology can do, I think there's a lot more. And sometimes that's under the surface. I think our last conversation, I agree. I had a lot of fun. I didn't flex my Bitcoin debate muscle before. I wasn't quite ready for that, but I think it was a great conversation. There's a lot under the hood, basically, right? So at first blush, this market, this industry can seem hard to understand. It can seem scammy, even, right? I think some of the top headlines that you see, the clickbait headlines are typically about the problems in the industry. Under the hood, the technology facilitates a lot more than that. So yeah, we'll get into it hopefully today. Things like tokenization of real world assets, things like stable coins. I think these are somewhat inevitable innovations. They're the way we interact, transact, and store value is inevitably going to change. How is that going to happen? I think largely through public blockchain networks.
So when we talk about tokenization of real world assets, give me an example. What are we talking about?
Sure. So originally theorized as this idea that you could, tokenize real estate. And people said, wait a second, how are you going to tokenize a deed to real estate? Well, it's not actually about tokenizing the deed itself. It's actually about using the token as, I like to think of as a wrapper, candy wrapper, or however you want to visualize that wrapper for a real world asset. So in real estate, right, a real estate investor isn't investing in the deed, right? They're investing in a partnership. They're investing in a legal structure that owns the underlying real estate and the associated rights of that real estate, and the obligations as well. And so, the tokenization of real world assets generally is this idea that you can wrap a real world asset, you can represent it on chain, and so it gets complicated, right? So let's just think about a spectrum real quick. I would put stable coins or tokenized dollars, crypto dollars, as some people have called them. I'd kind of put that on the real world asset bucket, just for simplicity. You could say, is a dollar a real world asset or whatever, but put it on the spectrum for now and say that's sort of the easy case, right? Have a dollar in the bank account and the issuer can create a token that represents $1. Then you get a little bit more complex. Well, what about a commodity, right? Like what about gold? Gold is valuable commodity, but it's very illiquid. It's not very portable, right? It's largely sitting in vaults, right? Okay, could you tokenize that and create markets that are more liquid and tradable on gold? Yes, a little harder than dollars, but you can do it. Far on the spectrum is real estate, right? Which is because the token has to reasonably represent the rights and obligations that come with that partnership, right? You could tokenize sort of a partnership interest, but there's a lot of complexity that comes with that: tax reporting and compliance, securities regulations, transfer restrictions, and all of those similar things that come with that. So,
Got it. So when we talk about tokenizing, whether it's a coin like a crypto coin that stands on its own, or it is something that is backed by the U.S. dollar or another fiat currency, or it's a physical asset in the real world, or a commodity, it's all represented by ownership on the blockchain. What is the benefit of putting something on a blockchain, of tokenizing it over the way we do things now? Like, why do you see tokenization of real world assets being a big thing in the future?
I think there's a number of factors. So liquidity is one of them. That's kind of a loosely used term, but what does that mean? It means that the investor has the ability to put capital into an investment, can reap the rewards, hopefully, of that investment, but also isn't stuck in it for a very long time necessarily, right? Doesn't have a lot of the barriers to exit. So real estate here is a good example. Again, it's one that there's a lot of work to be done on the tokenization of it, but it's an asset class. If you think about industrial real estate specifically, or commercial real estate, excuse me, right? So multifamily housing and triple net lease and office, et cetera, right? These are often owned by REITs, is one example of a structure that owns this type of real estate. Private partnerships and funds that own this real estate. And so investors come in to a deal, right? And there's potentially lockup period in that deal. If you want to get out, sometimes there's theoretical liquidity, right? But how does the investor actually get out? They have to find either another investor in the same fund that wants to buy them out, right? Which isn't always easy. Or they have to take that sort of share, that partnership share that they have, out to market, right? So they have a middleman, they have a broker, right? They've got legal fees for transferring. They've got M&A sort of deal assessment, due diligence, right, on the real estate itself. And so all of these things prevent liquidity, and they prevent the free movement of capital we're talking about real estate, right? But this could really apply to multiple different sectors. And so if you tokenize something, you have, theoretically a much freer transfer of that. So a number of companies have started this. I think T0 was the first one, right? But they essentially create a walled garden. So it's not a full public blockchain use case of this, more of a walled garden. You come in as an investor with the right, forget what these checks are called, right? Sort of you're a qualified investor, right? You've been qualified. You can sort of be within the walled garden, and now you have access to any of the tokenized investments that are within that platform. So, the promise is sort of buy Class A real estate in California in the morning, and sell it for Class A in Florida in the evening. That kind of idea.
Got it. So when the REIT buys a property, I guess if it's set up like to tokenize these ownership stakes, if I'm understanding it correctly, they could like issue 1,000 shares via tokens on the blockchain. I could buy one of those, and then because it's on a blockchain, because it's a token, there's a marketplace online where I could then buy and sell. I could sell my interest without having to go through this complicated legal process that it normally takes to do that.
Exactly. So reduced friction, reduced middlemen and fees, increased transparency as well, I think is a really interesting factor for the accounting world. Property, again, I keep coming back to that example because it presents a complex one, right? But
yeah,
in property,
it's very expensive right now to do that, right? It's like there's a lot of inefficiency.
Yeah, you've got the valuation of this underlying real estate, right? And then you've got sort of the management of it. You've got sort of its three nets. It's taxes, it's maintenance, it's insurance, and then you've got its income stream if it's income producing real estate. How are all these things validated? Well, think about a REIT, right? They've got thousands of properties. Let's say they're shopping malls and office buildings and the like. They're all managed slightly separately. Maybe they all use slightly different bookkeeping methodology. There's a lot of accounting sort of that's messy under the scenes. I think it's a bit future looking, but is the idea that you could standardize that process. You could think of an issuer who goes and buys real estate and standardizes the process of validating the income stream and as well as the outflows. And then I think, the valuation piece potentially comes more from the tradability of certain properties or like kind properties. So you're looking to comps essentially, which are trades on chain and trades in liquid marketplaces, as opposed to comps today, which are how do we value this shopping mall? I don't know. We got to look for one over here that sold recently. You're based on sort of very illiquid sales, sort of. So.
Right. So if people can trade their shares, if you will, I mean, that's not really, we don't want to use that term necessarily, because then we're talking like it starts to sound like stock, and there's a lot of issues. Go ahead.
No, I think that's okay, actually. So like, yes, the crypto industry wants to say that crypto, tokens like Bitcoin and Ethereum and sort of go down the chain are not securities, right? They're not within SEC jurisdiction, right? That's kind of been the case that the industry has made. Things that are a digital wrapper for something that is definitely a security, right? Like an investment in a real estate partnership is definitely a security. Offering that as a Reg D offering, right? So I don't think we're trying to avoid that. Putting a digital wrapper around it doesn't change the underlying character of it. There could be some incremental change in rules that could be really beneficial, like these transfer restrictions, for instance. That is something that's onerous, right? Transfer agent rules for knowing the identity necessarily of participants in the trade. Pretty difficult. While I'd like to see that sort of go away, I can also see the other side, which is, wait a second, you can't have sort of no identity verification in these types of trades. So.
And real estate's a great example because of the cost and complexity associated with like buying it, selling it, and tokenization could definitely streamline that. I see that. But it's not limited to real estate. It could be almost any asset, intellectual property even, right? Like an artist could sell their catalog of songs, and they could tokenize that intellectual property, theoretically, and fans could buy into it. And then if you set up the blockchain algorithm in the right way, they could actually get paid royalties. This could all be automated.
Yeah, theoretically. And there's been some real world examples of folks trying this. I think Spencer Dinwiddie was one of the first, a pro basketball player, to tokenize his contract, essentially.
Really? So how did that work?
I didn't read up on this before, so I don't want to misstate anything, but I would say not that well, basically. Didn't work out that well. And that was a case where, wait a second, he was raising money essentially, right? Taking fan investment, so to speak, right? And committing to some portion of proceeds from his contract. So he was kind of selling a future, basically, right, on his career, basically a securities offering. So I think that sort of fizzled. You got more successful examples. There's an artist, I think it's Blau. He's a digital music artist, EDM, electronic music, and he's taken a very crypto forward approach and direct fan engagement approach. And he's made NFTs out of his songs. He's been able to distribute royalties from those songs, directly to token holders. Here again, there's a whole like thorny nest of tax reporting issues, right? I mean, paying royalties, is a tax reportable event, right? I think is it the 600 rule and above, right? Might have varied, but I think it's $600 in royalties triggers a tax reporting event, right? Which is a 1099 obligation. How do you do that to token holders who have no name? They just have a wallet.
That's why you have to have the walled garden. You have to have some additional data that you collect. You can't just let these things loose.
Exactly. And frankly, like if you think about the walled garden, oftentimes you can really ask the question, well, wait a second, what's the point of tokenizing then? Because we have very good databases. If you're going to put everybody on a database ledger and give them permissioned access to a website, essentially, why does it need to be tokenized, right? So there's a really good critique of that. if we can imagine a world where identity isn't necessarily managed on a centralized ledger, but we're talking about this idea of sovereign identity, which is another thing that blockchains theoretically enable. Is the idea would be you can be an anonymous wallet address for, let's say, all the crypto trading you do, right, on chain. You could go use a DeFi protocol and trade tokens. But if you want to go buy a regulated product, you have to use your sovereign identity, right? You have to say, yes, this is my name and social and tax ID number, but you only expose that when you want to do the transaction. And the walled garden doesn't store that information. It's only checking, yeah, that's a person who's a qualified investor. They've been checked by another service, right? They have sufficient net worth and background and income and all the things that are checked. I think we could get there, but both music royalties and identity, very hard things to disrupt. So like over the past 8 years, I think there's been a lot of really smart people that have tried to disrupt this space. And music is one where, I don't know, is it an oligarchy or how would you
there's
describe
like 2 or 3 companies that manage all the royalties payments. All right, you get what,
right?
BMI, and I forget the other one, the big ones.
Yeah. So I wouldn't call them a cartel or whatever, but like jokingly would say, well, geez, how do you crack the cartel of music, right? It's pretty hard, right? I think because you've got basically like you said, a very few number of people that own the rights to the music. And then you've got a really limited set of distributors, I think is what they're called, right? Your Spotify's, Pandora's of the world. And those are pretty hard to disrupt too, because they have a very committed user base, right? They've got they've got the network effect pretty well locked in. How do you come as a startup business and completely disrupt both ownership and distribution, you know?
So that is like the future. We've got real world assets, tokenized. I'm really excited about that. I think there's a lot of opportunity, but we're not quite there yet, right? Most of the digital asset activity is still cryptocurrencies, not necessarily Bitcoin, all sorts of them, right? So I'm curious to know, Noah, like what is your firm doing? What's your business about? Like as a CPA firm specializing in digital assets, what services do you provide?
Yeah. So first a caveat, I think you're right. The majority is, I guess it's fair to say the majority is crypto, right? It's tokens and trading. There is a segment that is the real world assets, which is, again, if you put dollar stable coins on that list, that's a pretty significant market right now by valuation, by market cap, and also by its daily trade volume. And then there's a middle section of like commodities and gold tokens and things like that are starting to be tokenized and used, but still pretty immature. Yeah. So what do we do? Good question. So some of our specialties, I would say, are transparency. Like the thing that we actually care about in this space is playing the role that CPAs have played for a very long time in markets, is being a function of, you be a trusted function, right? Enabling transparency for investors, regulators, market participants. We think that's a very important role, right? It's a very weighty role. Crypto has, like in our last discussion we talked about, right? There's some bad headlines about crypto. Some of that is a lack of transparency, a lack of regulatory oversight, a lack of rules that has all led to investors getting harmed. And so we call this generally this bucket of proof of reserves is what we call it. And it's a nuanced topic. There's a lot to it. But essentially, it's transparency for the crypto space. So whether it's those stable coins we mentioned, are there actually dollars and cash equivalents in a bank account backing this up? That's one question of proof of reserves. For an exchange, let's say you've invested in some Bitcoin and you hold it at a centralized party. Proof of reserves also answers the question, okay, does the custodian actually hold enough of everyone's Bitcoin to meet all of the liabilities that it has on that ledger at a point in time?
Yeah.
And then the third use case is the ETFs, right? Like we've essentially tokenized the tokens, right? We've put a securities wrapper around the token, sort of the reverse of what we talked about before, right? Put a note around the tokens, and now they're traded on NASDAQ and the like. Okay, well, how does the note holder know that those note obligations are sufficiently backed by crypto assets, right? So how do we know GLD is actually backed by gold? How do we know that Bitcoin tracker notes are actually backed by physical Bitcoin held in custody.
Right.
So there's 3 big questions there in proof of
Yeah.
reserve that we can answer. Yeah.
And this is basically the fundamental role of CPAs in history. It hasn't actually been that long, but ever since the securities laws were written in the 1930s, it's been CPAs who are responsible for auditing companies that are listed on stock exchanges, public companies,
Yep.
and validating they have the assets they say they have, that they have the liabilities that they say they have, and that the identity equation of accounting adds up. That assets minus liabilities equal equity. And we don't have a lot of that in the digital asset space. A lot of these crypto companies are operating without any audits because they're not regulated, or they say they're not. And there's been this argument essentially going back and forth between the SEC and the crypto industry about whether that should happen.
Yeah. Yeah, exactly. I think it's true that there's a lack of transparency in the space broadly. I would say that the U.S. market is really the way it's regulated is by money transmission laws right now. So if any of the exchanges you can see online or that you might have interacted with if you've tried to buy crypto uh, are regulated on a state level, of course, there's the Federal Bank Secrecy Act, which essentially says the states shall implement a system of MTL laws, money transmission licensing. And so all of the states actually require financial statement audit as one checkbox for those license. And it's a patchwork of laws. There's a few different things, but so anybody who's doing like a custodial function or a trading function or the transmission of money payments platforms in crypto in the US is under MTL and is in the audit process, is starting or has done for many years now. The things on the periphery, like the token projects, the layer one blockchains, the foundations, that's definitely a space where you're right. There's like that. It's really hard to serve that public function of being a trusted provider of information because there's no standards. We're talking about potentially offshore entities. What are the accounting standards? What are the best practices? Right.
Right. So if you're in the US, if you're an exchange and you are taking money from US people in the United States,
Yep.
you have to have an entity here that is audited.
Yes.
Okay. But most of these exchanges, a lot of the activity is offshore, right?
Well, usually the exchanges have a pretty complex corporate structure,
Yeah.
right? The ones that I've worked with are definitely global entities, and so yes, they have a U.S. entity. Of course, a lot of times have a U.S. parent, but they have a whole corporate structure, right? That extends to offshore entities.
So, like an example for me is Tether. Tether is a stable coin that
Yes.
is that and Tether claims that it is backed 1-to-1 with US dollars, right? So if I buy a $1 of Tether,
Hmm.
it is backed somewhere by $1 of US currency. But
That's
Tether
the
has never been audited. As I like there have been they've done some audit like activities, but they've
yeah.
never gone through a full what we would call a financial statement audit like a public company here in the US. Is that right?
That's my understanding. That may or may not be true, right? Like Tether's a private company.
Right.
It may well have had a financial statement audit for one or more years, and it's just not public information. So it's possible. I think
So they haven't published any audited financials.
they have not published audited financials. There's a long history with Tether, and there's some interesting things that have happened over the years with Tether. It's a bit of a black sheep in many ways. I would say if you looked at across the stable coin market, they're the largest player, but they also have kind of a checkered past, frankly.
Yeah.
Today, my understanding of Tether is they've done their best to clean themselves up, but they've also been pretty tactful in, I would say, not necessarily skirting regulation, but being very defensive, being very strong, on their positioning. Today, my understanding is that BDO Italia, the Italian office of BDO, does an attest. So they do an attestation report on a monthly cadence covering the reserves. So they look at the total circulating supply of those Tether tokens across multiple blockchains, and they look to the custodial accounts at financial institutions that hold cash and securities. And they do that asset liability matching, and they report on it. So
So that it's a proof of reserves report. Is that what they're producing?
I would say
Is that what they
yes.
call it?
Generally, it's like this is a technical thing, and people have been accused sort of overstating the value of proof of reserves in the past, and I think that continues to happen. So I'm always very careful. You don't get an elevator sort of quick answer from me on proof of reserves on any topic, but this is one too, where it's like, yeah, generally it's in that domain of proving reserves, right? But how is it done? Well, it's a point in time attestation report, right? My understanding is it's issued under IFRS standards, so it's sort of it would be the equivalent of an examination report here in the U.S., an ATC 205 report, but it's done under the IFRS standards.
Okay, and what is happening in a proof of reserves engagement in general? I know they can all be different, right? But like, what is the idea?
Yeah, well, let's stay on stablecoins for now, right?
Okay,
Because that is really just the easiest version of this asset liability matching exercise. So we have a liability or obligation. Is it a liability technically, right? People will argue about that. Shorthand, it's a liability. It's an obligation of the issuer, right?
Tether says I can exchange my Tether for US dollars at this pegged value. That's the liability.
One more caveat, this is actually a layered system. If you think about it as a sort of an onion, in the center of the onion is the issuer. This is Tether, right? The next layer out on the onion is actually direct customers of the issuer. And these are largely exchanges, actually. So for instance, if you wanted to go sign up with Tether, you can't, neither can I, both for those jurisdictional reasons, licensing reasons, etc. So that second layer, again, is the big players where they go source and trade with Tether. And the third layer out is retail, essentially, right? And that third layer is provided by the global exchanges of the world, the Binance and KuCoins and Huobi's and etc. So we as retail get access to this dollar pegged promise by the fact that the exchange we're on has a sufficiently liquid book to where supply and demand doesn't push Tether too far off of a dollar. So yeah, sorry, long answer, but
so I guess dumb it down for me.
The underlying promise, a couple layers down, that's the promise, is that yes, it's redeemable. Yeah.
What is the proof of reserves proving?
So the proof of reserves is an attestation, right? So if it's done under examination standards, right, it's putting the auditor's opinion that management's report over custodial assets and liabilities is fairly stated in all material respects at the point in time. So typically the way these are architected is the auditor's opinion letter or independent accountant's report page, which says we've examined this, right? Here's kind of the scope. Here's our opinion. Here's any call outs, caveats, deviations, signed off by the firm. And then the second report, which is the subject matter of the attest, can be a couple of things. One, it's disclosures. So it's typically a couple of line items that say total circulating supply of tokens, total assets in custody. So there's a sort of one-to-one matching. And then there's a bunch of assertions, and there should be as well, management assertions, right? And so those are things that the auditor tests as well, right?
So do you do these proof of reserves reports?
We do, yeah.
So how do you go for it? How do you do them? Like, how does it, like, how would you actually go about doing a proof of reserves for Tether or any other stable coin or any other digital asset? What do you look at?
I mean, a lot of it's kind of like an inventory count type of exercise, right? So let's talk about liabilities first on the public blockchain side. So you have to ask first, can these blockchains serve as a sufficiently reliable source of audit evidence? Can they be sufficient appropriate audit evidence gained directly from a blockchain? Can you go to the blockchain and confirm, right, that there's a balance there? And yes, you can.
Theoretically, if it's set up right, you should be able to do, because the blockchain is public. You can download the whole history, the whole entire ledger for all time and analyze it.
Right, exactly, which we call hosting a node or a full node would be downloading that full ledger.
Okay.
Right. Yeah, and the AI CPA even, right, has this in recent standards updates that blockchains can be can provide sufficient appropriate audit evidence. So there's a couple of things the auditor wants to do behind the scenes to document, okay, what blockchain am I looking at? Like, is it sufficiently decentralized? Like, is this balance relatively reliable? But for the largest blockchains, we've gotten past that over the 3, 4, 5 years ago now. But anyway, yeah. So you look to stablecoins are held in a smart contract essentially. So there's a smart contract that will record the circulating supply. There's a vending machine on chain, right? And you can look to the vending machine and it knows the circulating supply of tokens. They may be held by many different participants in wallets, right? Many different people
Yep.
globally, but that's the place you look, right? So now you get circulating supply. On
So
the asset side,
that's the big number. That's the number you have to now confirm on the asset side that it
exactly.
equals or exceeds.
Exactly. Right. And so it's an examination process the way we do it, right? It's an examination engagement. So all of the typical audit tools apply. So, you inquire, you understand their custody process, you understand the counterparties and custodians that they work with. You understand, even internal controls, although you don't have to test internal controls to reach your opinion. You do look for an understanding of internal controls. And then what do? From there, you shoulder surf, you observe, you test directly by getting read-only access and the like, basically, and document as such. But yeah, essentially you're looking to banks, right? So what's the cash account and what's the treasuries account? And you're summing up
You're
total
summing
value.
up all the government bonds I've purchased with the U.S.
Yep.
dollars I've received, with the money I've received to sell the stable coin. You're making sure that the money I've got in those money market funds or in those bonds or in those cash deposits all sums up to the total tokens outstanding or the value
Yeah.
of that.
As well as a number of other potential assertions that can be in these reports. Like one important one is, okay, well, is that a company account? Is that some sort of a trust account? Is that held on behalf of, is this specific account at the custodian held on behalf of token holders, for instance? So yeah, there's a number of other things that play in there, but that's the basic process. I mean, look to the blockchain, look to the custodians, bring the two together.
So what are the limitations of these proof of reserves reports versus a traditional audit?
Versus a traditional audit, I mean, there's a lot of ways to compare and contrast them. I mean, in terms of their assurance level, it depends how they're done, right? So a private,
because they can all be done differently, right?
Yes, exactly. Well, to a certain extent, right? Like as a CPA firm, as an audit firm, the way we approach it is there's really kind of two potential AI CPA standards that could apply: ATC 205 examinations and ATC 215 agreed upon procedures. So there's a quick distinction there too, because in terms of that word assurance in the way the accounting industry uses it, it's a very important term. Examination opinion is an assurance vehicle, whereas an agreed upon procedures report is not quote unquote assurance vehicle, right? It offers no assurance. And so all of these things are relatively in the domain of limited assurance. So now let's take the examination. Let's leave the AUP aside for a second. Let's take an examination of opinion over a stablecoin issuer and their reserves and compare that to a financial statement audit. Well, those are both limited assurance engagements, or assurance engagements, generally speaking, right? The auditor for the financial statement audit gives an opinion that the financials are fairly stated in all material respects, right? Given relevant standards. And same thing, I've read that one to you, read out that one for the stablecoin examination. So in their assurance level, relatively comparable. It's their scope, right? It's the standards that really sort of matter. So one way to think of a proof of reserves for me, whether it's an exchange use case or a stablecoin, is like it's a narrow view of the balance sheet is one way to look at it. They're important too. Like it's kind of a contrasting factor, but like if you think about those exchanges, okay, let's try and stay on stablecoins so people can follow us here. Let's think about that second layer of the onion I talked about, where or the first layer of the onion, where exchanges are actually buying directly stablecoins with the issuer. Okay, so they're holding a bunch of stablecoins. They're really holding most of them, right, for you, me, for other customers, and they're held in these commingled wallets, or pooled wallets, probably is a more proper term for it. So everyone's assets essentially is in one bucket, and there's a ledger at the exchange that says, you have 10 stable coins and I have 10 and everybody else has 1,000 or whatever. So if you think about a proof of reserves in an exchange use case, under a private company audit today, like the standards don't require that those assets be on the balance sheet. So they can be in a footnote, they could be supplementary reporting. That exchange could go through a financial statement audit, and the auditor could theoretically never test those off balance sheet assets. They could never test whether those stable coins are actually held sufficiently to meet all the liabilities that they have or customer obligations they have, right, to the people on the platform. And so this is an important vehicle. Like it could be said, wait a second, it might not offer assurance. It's not the whole picture. You don't know if they're actually a solvent business. You don't know anything about, right, the rest of the financial operation. But at the same time, nobody's getting access to the private financials of an exchange anyway. So this is a vehicle on top of that does offer some transparency to the customer level, which they would have no transparency anyway. And it's also potentially covering something that wouldn't be in their financial statement audit anyway. And if it was, it probably would be tested on a sample basis as opposed to a 100% basis, which it can be in the attests.
So this is wild. What I'm hearing is that like a U.S. exchange could go through a financial statement audit, but that audit doesn't necessarily test whether or not the wallets that they are holding commingled funds in actually that they control or they own, that because those are off balance sheet.
Yeah, I mean, if you think about it, if you think from scratch and you think if you're in the accounting chair, you're in the CFO chair at the exchange, like let's say your revenue is, $10 million a year or something on trading fees. Are you going to put $1 billion worth of customer assets on your balance sheet?
But that's what banks do, right? Banks have to show customer deposits on their balance sheet. And so
exactly.
and those get audited to make sure that they can actually pay back the depositors.
There's specific accounting rules around that and disclosure rules, and it also sets their capitalization ratio. Basically, it sets like, okay, how much like sort of lending activity can they actually do on that balance sheet. So that's an important, slightly similar and also different from exchanges. But yeah, the private company sort of standard accounting rules, under GAAP, don't necessarily say that needs to be an asset and corresponding liability on the balance sheet.
That's kind of wild because a lot of people are using exchanges as banks for their crypto, essentially, right? I hold my crypto at this exchange. Let's say it's FTX, right? And there's there currently, under the current rules, there is no requirement that this exchange is audited and has to prove that they actually have the deposits still. And like that's basically what happened with FTX, right? Is that they were siphoning off the customer deposits to gamble in a related company to speculate.
Exactly. Yeah. So we've been banging this drum for a long time. The first proof of reserves that I did with the team was at a different firm, but it was the first time a CPA firm had ever done or used AI CPA attestation standards to cover this subject matter and present it in this way. Basically, the first time that a CPA had done a proof of reserves over an exchange. And we did that for Gate.io. They're top 10 or 15 by daily volume, so global exchange. They don't really have a US presence, but they have a global presence. And so been doing these for quite a while. And I think they're important. Like, I think there's plenty of potential criticisms to, wait a second, if it's done under AUP, there's quote unquote no assurance. Okay,
right.
There's no assurance, quote unquote, but that's not how normal people think. That's how accountants think. That's how accounting firms think. That's how they think about their own risk profile, essentially.
So we have this product, a proof of reserves report, which can be done under two different standards, one which provides limited assurance and one which provides no assurance, and it's called the same thing.
Generally in that bucket. Yeah, exactly.
Yeah. So that is incredibly confusing to the public. I mean, it's confusing to me, and I'm a CPA.
Yes, we come across this pretty often, that even folks that are in the space, even our trained accountants and licensed struggle with these topics. It's not rocket science, and I think it's things that the public can understand right, with the right explanation and the right transparency around what we're actually doing. So yeah, there's those criticisms, right? Like, is the intended user of the report actually have sufficient knowledge to understand the subject matter of the
Yeah.
report and its opinion? Yeah, that's a valid criticism, right? Like, that's a valid criticism for anything. I mean, look at the public markets. Do you think that people who are investing in Tesla stock through Robinhood have any idea about PCAOB level reporting and SEC standards and how to read a 10K? Like, absolutely not. So
They don't,
we
but
rely on another layer. We rely on the
yeah,
investment banking layer, right?
they're
To
relying
do
on
the
the analysts, the investment bankers,
yes,
the sophisticated investors, and they're
right.
basically what do you call it? They're drifting off of
Riding
that.
the coattails.
They're
Yeah,
writing
exactly.
yeah, exactly. So they have the assurance of the whole system,
Mm-hmm.
and feeling secure in knowing that we have a system that has these checks and balances
Right.
to actually make sure that Tesla isn't just making up the numbers, which
Exactly.
is
And at
like,
the end of the day, it's a system, built of flawed human beings doing our best to, uh, follow standards, right? And so
right,
there's plenty of examples in the public markets where, yeah, things didn't go quite the right way. That layer of, high paid analysts and auditors and everything else didn't actually work to the benefit of the end investor, right? There's examples
yeah,
of that. And I think just our approach to this space is like, incremental steps are better than no steps, right? I think that there's an inevitability here, right? In terms of crypto exchanges will be things, people will invest in crypto, whether you like it or not, wherever you are on that spectrum, it's going to happen.
right,
There should be a regulatory perimeter around it. If it's going to be in the U.S., then there should be proof of reserves should be part of that transparency stack, of that compliance stack, and that regulatory perimeter. Without it, like, regulators on the state level right now completely lack visibility to the reserves of these exchanges. They just do, right?
yeah,
And
and it's
financial statement audits, which are required, don't get them there. So the idea of attacking or saying this thing that you're talking about, proof of reserves, has problems and caveats and nuances and is hard to understand. Like, okay, yes, that's true, but it also is moving in the right direction, right? Like,
right.
this gives regulators a tool that they don't have. They completely
Yeah.
lack right now. So
If crypto is actually going to be a legitimate alternative to the traditional banking system, there's got to be assurance that these reserves exist, that the money that I keep at an exchange is actually deposited there,
yeah,
or if it's being lent out, like at a
yeah.
bank, that there is sufficient reserves, like banks have to maintain. They have to
Even
maintain
if you
certain capital requirements.
Right. Even if you're like a skeptic and you say, no, this is never going to be a legitimate alternative to the banking system, it still is going to be something. Is it check cashing? Right. Check cashing is regulated by money transmission as well. Do people think that's a reasonable alternative or a good alternative to the existing banking system? No, probably not. It's probably largely predatory and probably largely unfair, but it's regulated, right? And it should be regulated in the right way.
Yeah.
And so I don't think that crypto is check cashing or predatory or anything, but just it will be something, right? Whether it's online gambling or check cashing or digital assets or betting on sports online, these are ways that people are transacting value online. And a lot of times there's sort of reserves or customer money in the system and deserves to be protected.
Yeah. So right now, it's essentially optional. There's no requirement that these exchanges need to get proof of reserves reports.
There's a few things moving. So Texas was the first to create a proof of reserves law and called as such, and it's specific to exchanges that operate in Texas. There's a few triggering factors. I think it's 10,000 customers in the state or a certain number of value of assets. Basically, trips any exchange into this requirement. Um, excuse me. It's a lot. Texas is a whole podcast of its own. It's very interesting to see the way I think state legislators did the right thing. I mean, they said, "Hey, look, Texas customers, Texas citizens were harmed by the collapse of FTX.com in 22. Let's do something about that." Right? They looked to proof of reserves. They saw that this was something that could be done. They said, "We should do that, and let's put a CPA stamp on it." Uh, Again, long story short, that legislation has been difficult to bring into reality just because of the way it was written and the way the Department of Banking in Texas can actually go about requiring this analyzing the reports that they receive, et cetera. But there's actually a lot, significant movement in that direction. So, New York has been very forward on crypto regulation. They have I guess you'd call proof of reserves requirement for the stablecoin issuers that are licensed in New York. And so those issuers have the mandate to do this monthly attest, as well as a day within the month, and also a controls report annually as well. So that's a pretty good example of pretty onerous, frankly. It's pretty high bar to do that stuff. It costs a lot. It's complex, but ultimately, creates.
I mean, how else do you protect customer money without
Exactly.
some third party verifying it's actually there?
Yeah, I mean, I think that self-regulatory, I don't want to say that self-regulatory means like aren't valuable. I think that if you look at Circle, they're the second largest issuer of stablecoins. They're a US company. Their product USDC, right? They started the attestations years ago. They do it on a monthly cadence. They've had Deloitte and Grant Thornton, I believe, have been in that chair over the years. It's a self-regulatory thing. Yeah, it's not required by any one state, but the fact that they're putting the information out to the public, to the customers, it has a forcing function of its own. I mean, that is real, right? Like if you're within the business and you're putting out this information, it's like, it better be right. You're doing hopefully your best to make that honest and accurate information. And hopefully it's also driving internal control and process and all the good things you need to do inside to be able to do good reporting outside the walls of the firm.
So
not foolproof for sure, but.
Well, so the picture I'm getting is that like proof of reserves, some sort of assurance around customer deposits, that these funds exist, that these coins exist, that the blockchain for each of these coins is set up in a way that can't be manipulated, like you said, distributed. Somebody needs to sign off on that. CPAs, that's our traditional role. Like that's what we do. So we have a huge opportunity to be the auditors of crypto, essentially. And but there aren't many firms doing it, right? Like you're one of the few.
It's ebbed and flowed over the space, and the approach of the years, and the approach to the space has been different. The first approach was, it's not about Bitcoin, it's about blockchain. Big firms, like, let's go sell the Fortune 500 their own blockchain, their own implementation. Let's do those proof of concept things. It evolved into, digital assets are kind of a real thing, and there will be sort of continued proliferation and expansion of this market. And so, some of the larger firms started to do audits. I would say the big four were very selective about who they would audit.
Yeah, they've stayed away from it a lot. They've really avoided it.
Yeah, especially in this space. I mean, certain firms I won't name, but there's one of the big four that's actually very active in crypto funds, and especially through their Cayman office. Each of them has kind of taken their different approach, right? One of them is very still involved in sort of the not crypto but blockchain side, and is developing technology. For one of their large clients, has projects that they've released. That's an interesting approach to the space. But the state of the play today is that for the last 4 years, the PCAOB has generally been kind of hostile, frankly. I think in terms of its approach to regulating PCAOB registered firms. So they've had sort of the impact of 2022, seeing other firms publicly named and shamed by senators and PCAOB. Then they've had sort of investor alerts. There was an investor alert around proof of reserves, right, issued by SEC Chief Accountant Paul Munter, which is covers a lot of things we just talked about. And then there's just like the general sort of approach that PCAOB has taken to firms, even outside of crypto. And so, the biggest firms have been scared away. The middle market firms, frankly, weren't very well tooled anyway. Like many of them didn't have their own tools or very deep practices. So they were doing some tax work, maybe they were doing some consulting, but they really weren't doing auditing and attest work. And so, there remains today a handful of firms, but growing now. I think firms are definitely coming back into the space right now.
Well, it seems like a big opportunity because it seems inevitable to me that proof of reserves will be eventually required everywhere, because it just makes sense. Like we need to have regulation around this space. If a firm let's say we've got some CPAs listening who do audit, are interested in getting into this space. Just putting myself in their shoes, I would think I already know how to, audit what's in the bank, the asset side, but the liability side, the blockchain side, like that's a whole new thing. Where can CPAs learn how to do that side so they can do these proof of reserves reports?
Well, we're happy to teach you. Our goal actually in this space is to ensure that more firms can do this work. So, slight tangent, but in developing all these tools, we created a product called LedgerLens. It's the first and only tool that's really purpose fit for CPAs and auditors to accomplish financial statement audit engagement. So you can test the balance sheet, right? You can roll back balances and know 1231 point in time balances in many wallets at a time. You can do digital signatures to prove ownership of the assets on the balance sheet. You can do transaction testing in high volume of selected samples. Like there's no other tool that does that. So when I say we can teach you, that's actually honest. Like the network firm, people might think, wait, why would they focus only on one industry? That seems so like, why would you do that? Like, yeah, there's industry specialization, but you lack diversification, right? Like bad crypto cycle, bad time for the firm. Well, it's actually more about using the network firm as a way to prove that CPA standards and services can be tech enabled. They can be delivered to the space. You can use these tools to create transparency and positive externalities in the market. And so LedgerLens is sort of the vehicle for that, right? That firms can now buy a SaaS tool, right? Commercially available
Right.
and 15 blockchains supported, and it actually does the things you need it to, as opposed to being the midnight manager, like searching for some source on the internet that can give you a point in time balance for this wallet or hundreds of them or thousands or tens of thousands of wallets at a point in time.
Yeah.
So we are really willing to teach you. Part of that is, we don't think that every firm is going to click and buy software because they're not ready, right? So the idea is, hey, we can be your digital asset practice in a box, but we can support you in many ways, from the education side all the way through to the actual tools to do these engagements in a risk-reduced way. There's other resources too.
You're making me want to start. You're making me want to start a CPA firm, Noah. I mean, it seems like this is a huge growth opportunity. So, like, it's going to happen. You've got the tool, and I could learn. I wish I had more time.
I don't know. You're too good at this. What you do right now.
This is so cool. So that's ledgerlens.io, right?
Yeah, ledgerlens.io. Yeah, that's the site if anyone wants to check it out.
Sweet. And Noah, if people want to connect with you online, where's a good place for that?
Yeah, hit me up. Give you my email, right? The normal naming convention, noah.buxton@thenetworkfirm.com. You can hit us up through the website too. Feel free to just talk to an expert, schedule a call button. You can put time right on my calendar or the team's calendar, where our door is always open.
Awesome. Noah, thanks so much for taking the time to join me. I've really enjoyed this conversation. Hope to chat with you again soon.
We went really wide and a little bit deep, and I appreciate it, Blake. Thanks.
Thanks for listening. I hope you enjoyed this episode and that you learned something new. And if you did, wouldn't it be nice to get some CPE credit for it? Well, I've got great news. My new app, Earmark CPE, offers free NASBA-approved CPE credits for listening to podcasts, including this one. Visit earmarkcpe.com to download the app, take a short quiz, and get your CPE certificate. That's earmarkcpe.com.